Hi, and welcome to The Full Perspective. I'm Charlie Thomas, Content Director for the Insurance Insider, and each week I'm going to be talking to some of Insider Publishing's senior staff to dig into some of the week's most significant stories. Today I'm joined by Insurance Insider's Editor-in-Chief, Adam McNestry, and Trading Risks Managing Editor, Fiona Robertson. So we're going to start this week's episode with the collapse of Covéa's proposed takeover of PartnerRe. PartnerRe's parent company, Exor, and Covéa signed a memorandum of understanding for the deal back in early March, which would have seen Covéa pay $9 billion cash for the Bermudian reinsurer. But on the 12th of May, statements from both companies confirmed the deal had collapsed. So, Adam, what's your take on all this?
I think we realized from what's happened within the broader economy that there's some pressure around asset prices. And I think we'd flagged up before that there was at least going to be scope for Covéa to attempt to exercise leverage and renegotiate the deal price. I'm still pretty surprised that this has happened. It's one thing to apply some leverage and to try to negotiate a better deal. It's another thing to walk away from the table. I think you've got to try and I think it's difficult to understand Covéa's mindset exactly, because ultimately, when you're conducting M&A and you're buying a private company, it's not just a case of a simple read across from public markets valuations. You've got to look at the intrinsic value of the business that you're buying. And is PartnerRe intrinsically a less valuable business than it was? There's been a bit of a hit on the asset side, or that's sprung back. There are some underwriting losses to come for sure. But actually also there's a more positive picture for the business going forward in terms of likely underwriting income. I think the whole mindset that says that because the valuations of the Bermuda peer group have gone down meaningfully, that PartnerRe is worth $1 billion or $2 billion less than they agreed to pay for it. I'm skeptical around that. And then one final point, just to say that the deal itself, the deal agreement, the MOU, specifically references COVID-19. This deal was done in early March, and Covéa was already aware that there was significant risk in the system as a result of that, and it agreed the price despite that.
No, that's true.
I think that said, though, in early March, probably all of us were still a little bit in that denial phase about what the pandemic was going to mean. And I think there's just a lot of people who are rethinking, investment strategies at a personal level, buying houses, and at a corporate level. I can see why Covéa might have wanted to renegotiate, like you say, and ultimately they didn't make it happen. But I think that there is a case to be made that the fundamentals have changed, not just the market valuation.
I think the other issue that you have here is that Covéa has made it crystal clear that it really wants to be in the reinsurance market. It's a huge player in the French insurance market, big cornerstone domestic presence, but it has something like $10 billion of cash, and it kind of has nowhere to go. And by going after SCOR in the way that they did, and by ultimately being unable to get that deal done, and now coming after PartnerRe and ultimately being unable to get that deal done as well, you have to ask, where do they go from here? They've hurt their credibility as an M&A counterparty. I think it's going to be increasingly difficult for them to do a deal. Or if they are going to do a deal, they're probably going to have to pay something like danger money in order to do it. So although there was a relatively small break fee here, they're going to look at potentially having to pay significantly more further down the line for any business they were looking to acquire.
Yeah, I suppose a lot of it will depend on how COVID-19 affects the wider M&A market too, right? Because, while you would expect a kind of pause in current deals, there might be potentially a spike in future distressed BI claims leading to fire sales, and suddenly a big reinsurer who may have been off the table before might suddenly be looking for somebody who's got a cash deal that, Covéa could provide for them.
I suppose it's possible. And, they could go and buy Sirius as a business that's up for sale right now. But I think they had a major reinsurance only franchise, which really fit the bill for them and had significant scale for a business Covéa's size. I think they're going to find it hard to find anyone else who fits the bill.
And what does it mean for PartnerRe? We saw the statement today that Exor said it was never up for sale anyway. We love it. It's fine. But what does it mean for PartnerRe going forward?
I think it creates uncertainty for PartnerRe going forward. I don't think that Exor is about to pull the trigger on an attempted sale of the business. I think they're very shrewd when it comes to M&A. And I wouldn't expect them to do that. It would be selling at a moment of weakness. But it creates a kind of overhang, as happens with any business where there's uncertainty around medium-term ownership. And it just unsettles people at the business. It makes it harder to recruit. And it also, at the margins, it makes it harder to retain your client base. So I do think it's a negative for PartnerRe, and I think it's something that that management's going to have to work hard to deal with.
Okay, well, let's leave that one there for the time being. I'm sure we'll return to it over the summer. But the other big focus this week has been on Florida renewals, talking about June, July and summer. The key headlines, for those of you who may have missed them, are that Floridian insurers are now facing far higher rate increases than anticipated as fears over the scale of COVID-19 exposure drive risk-adjusted increases as high in some cases as 20 to 30%. Fiona, what would you say were sort of the key takeaways for anybody who's not up to speed on the story so far?
Yes, well, I think keeping it at a high level is just really noticeable how much the dynamic has changed even in the last few weeks. And without, this week is going to be a critical week for where the rate increases ultimately land, firm order terms coming out, reinsurers getting back to brokers. It's still a little bit in the standoff phase. But at a very high level, one of the interesting things I think is just that the negotiating power has gone back towards the reinsurers. We are actually seeing real concrete change on terms and conditions. And people have always talked about that. And last year there was some talk about trying to clean up terms and conditions in Florida. And this year it's actually happening. So cascading covers, for example, more reinsurers saying that they're not willing to write them or having them removed from programs. I believe there are still some carriers writing them for what they see as the right price. But what that does is it removes an element of aggregate exposure for those companies if you're not doing cascading covers. And so that is a really positive step, I think, that many reinsurers will see as a concrete outcome that's been taken this year.
Mm-hmm. And have we got any indications yet about what's happening in retro?
I think just getting tighter and a harder market. There's a lot of talk about whether trapped capital or trapital will again be a problem for the market going into next year. There's really not very many data points though until January. So possibly a little bit early to tell. And of course it all depends on how much leakage there is from property BI claims into the reinsurance market in order for the retro capital to be trapped. But certainly it's going to be another area where it's going to impact the Florida market because a lot of Florida reinsurers have been very reliant on having a lot of hedging in place. And if the cost of that is becoming more, is probably into its third year now, quite significant increases, it just changes the dynamic again and makes sure that people are sticking to their resolve of what they want to achieve on the incoming side.
That's great, thank you. And Adam, is there any read across that we can take from what's happening in Florida for other renewals, or is Florida just too nuanced for that?
Actually, just before that, Charlie, the other thing I wanted to say was that I think it's playing out as a really interestingly differentiated renewal in a number of different ways. So you've got divergence in terms of pricing for high quality Floridian standalone businesses and for weaker businesses that have either generated more loss creep, have more tri-county exposure, have those kind of service businesses where LAE becomes a profit center. So I think you've got a divergence around that, but you've also interestingly got a divergence around market tactics. So if you got your renewal sewn up towards the end of April or right at the beginning of May, maybe you did get plus 15 or even plus 20% risk adjusted. And if you're trying to do it now, you're probably at plus 30% risk adjusted unless you're a really weak company. But the expectation is that gets even harder as we run in towards the very end of the renewal. So people who are still trying to sort out a kind of patchwork quilt deal on the 29th and the 30th of May, they're going to face a real challenge.
And more private deals as well on that theme. So it will be more differentiated by reinsurers and harder to get a handle on the average outcome.
Right. Yeah, no, I think so. Yeah, I'm told there's a ton of non-concurrent pricing. In terms of the broader read across, I think it's difficult. People look to Florida as a kind of bellwether market because it's such a big cat market and because it's been so profitable at various points. So it's definitely very prominent. I think the degree to which it's a good bellwether for the broader market is kind of questionable because it has such unique features that the standalone carriers need to buy. It's peak zone risk, it's capital intensive. The ILS market participates on the first tier reinsurance. It's also very reliant on the retro market as a whole. So I don't know. I think that there's a big question around what happens to the broader rating environment, but I don't think you can just do a straight read across from Florida to everything else. That said, it's getting harder in Florida than it was, and it's expected to continue getting harder in Florida, and you'd expect that there'd be at least some parallel in other reinsurance markets.
Fiona, on ILS perhaps?
Yes. Yeah. Well, I think one way that the Florida market is possibly a slightly narrower bellwether is regarding the ILS market, because, as Adam says, it does have that bigger market share. You can perhaps get more of a sense of how capacity is shaping up on the ILS side. But yeah, arguably the Florida market is coming back off such a steep reduction in rates that happened before Irma that we'd be wanting to see some data from outside Florida, elsewhere in the US, internationally, and some of that business will be renewed soon as well. So.
Mm-hmm. Yeah, that's true. Well, 2 weeks is a long time at the moment, isn't it? So I guess we'll have to see how the next 14 days or so plays out. But that's great. Thank you so much, guys. That's all we've got time for on this particular episode. Thank you to Adam and Fiona for joining me today. And thank you guys for watching at home. Until next time, stay home, keep safe. And we hope that you will join us for next week's episode in a week's time. Thanks very much.